The Federal Reserve wrapped up its latest FOMC meeting, keeping interest rates unchanged to hold policy steady. Investors watched closely for what the Fed plans to do next. Inflation remains the central issue. While price pressures have cooled significantly, they haven't yet reached the Fed's long-term 2% target. Policymakers made it clear they want sustained confidence that inflation will continue to move in the right direction before making further adjustments. The Fed is walking a fine line. Economic growth is slowing but remains resilient, giving the committee room to be patient while avoiding a collapse. However, easing too quickly could reignite inflation. For now, policy remains steady as the world watches for the next signal from the committee.
What if you could trade serious capital without risking your own savings? No massive deposits, no stress. That's exactly where Instant Prop Fund comes in. Instead of risking your own money, Instant Prop Fund gives you access to a professionally funded trading account. You trade using proven rules, and when you perform well, you get paid. We remove the emotional pressure of trading your own funds. Focus purely on execution, discipline, and consistency with flexible account sizes and clear profit targets. Traders keep a high percentage of their profits with fast, reliable withdrawals. No hidden clauses. If you have the strategy and discipline, we have the capital. Join Instant Prop Fund today. Prove your skills and start trading with confidence. Instant Prop Fund. Trade smart, trade funded. Chair Jerome Powell emphasized that Fed decisions are now data-driven, with no preset path or promised timeline for rate cuts. This wait-and-see approach means evaluating every inflation report and jobs number as they arrive. Markets reacted with mixed signals. Stocks fluctuated and bond yields shifted as investors parsed every word for clues. Within the committee, a notable division emerged. While most favored holding rates steady, some worry about growth while others focus on inflation. For everyday Americans, this means mortgage, credit card, and auto loan rates will likely stay elevated for the near term. On the flip side, savers continue to benefit from higher yields on savings accounts and certificates of deposit. As the Fed navigates this uncertain environment, the focus remains squarely on the incoming economic indicators. Businesses are feeling the impact. High rates continue to slow expansion and investment, although well-managed firms are finding ways to adapt. Political complexity adds another layer, with potential leadership changes at the Fed likely to influence future policy direction and priorities. The coming months are critical. Inflation data and employment reports will determine if the Fed feels comfortable easing policy later this year. The key takeaway is caution. Policymakers are signaling patience and flexibility, remaining committed to data-driven decisions rather than declaring victory. These decisions shape everything from your mortgage rates to job opportunities and overall economic confidence. Every report now matters just a little bit more. Stay updated on the Fed's next move and what it means for your money. Subscribe and leave a like. Thanks for watching.